If you have spent any time on social media, you have seen it. Somebody in a nice car talking about how they made $10,000 day trading before noon. Screenshots of portfolio gains. People making investing look like a cheat code. And then you get into it, or you try to, and it is nothing like that. Here is what nobody tells you up front. There is not just one way to invest. There are several, and they are not all created equal, especially for someone who is just starting out. Today we are going to talk about all of them honestly. Let us get into it. Welcome back to Cents and Commas. We have been building your foundation all series long, and this episode is one of the most important ones yet. Because before you put your money anywhere, you need to know what kind of investor you actually want to be. The strategy you choose affects everything. How much time you spend, how much risk you take on, how much stress you carry, and honestly, how likely you are to actually build wealth over time. Let us walk through each one. Long-term investing is exactly what it sounds like. You buy stocks, index funds, or ETFs, and you hold them for years, sometimes decades, letting time and compound growth do the heavy lifting. The philosophy behind long-term investing is simple. The market goes up and down in the short term, but historically it has always trended upward over long periods of time. So instead of trying to time every move, you stay in. You do not panic when the market dips. You keep contributing regularly, and you let your money grow. This is the strategy behind most 401ks and IRAs. It is the strategy Warren Buffett has used for decades. And it is the strategy with the most consistent real-world results for everyday investors. What it requires: patience, consistency, and the ability to not check your portfolio every 5 minutes and spiral when the number is red. It does not require a lot of time or financial expertise once you are set up. That is a major advantage. What it does not require: being glued to a screen, predicting market moves, or making fast decisions under pressure. Dividend investing is a form of long-term investing with a specific focus, building a portfolio of stocks that pay you dividends on a regular schedule. Remember from a previous episode, a dividend is a portion of a company's profits paid directly to shareholders, usually every quarter. Dividend investors look for stable, established companies with a long history of paying those dividends reliably. The goal is to build what is called passive income, money coming in on a regular basis just from owning the stock. Some investors reinvest those dividends automatically to buy more shares, which accelerates compound growth. Others, especially retirees or people trying to replace income, take those payments as cash. This strategy is lower risk than trying to chase fast gains because you are focused on stable companies with proven track records. It is slower moving, but it builds something real. What it requires: research into which companies have strong, consistent dividend histories, and patience to let income build over time. Growth investing means putting your money into companies that are expected to grow faster than the average market, even if they are not profitable yet. Think of early-stage tech companies, biotech startups, or innovative businesses disrupting their industries. These companies often reinvest every dollar they make back into growth, rather than paying dividends. They are betting on the future, and if you pick the right ones, the returns can be significant. The trade-off is volatility and uncertainty. Growth stocks tend to swing harder in both directions. When the market is optimistic, they can skyrocket. When sentiment shifts or earnings disappoint, they can fall sharply. Growth investing requires a higher tolerance for risk and a willingness to do deep research on individual companies. It is not a passive strategy, and it works best as part of a diversified portfolio, not as your entire approach. What it requires: comfort with risk, strong research habits, and a long enough time horizon to ride out the swings. Now we are moving into more active territory. Swing trading is a strategy where you hold a stock for a few days to a few weeks, trying to capture a specific price movement or swing before getting out. Swing traders are not holding for years. They are looking at charts, identifying patterns, and making calculated bets that a stock is going to move in a predictable direction over a short window of time. This requires a solid understanding of technical analysis, reading charts, understanding trend lines, volume patterns, support and resistance levels. It is a skill set that takes real time to develop. Swing trading sits somewhere between long-term investing and day trading. You are not glued to a screen every minute, but you are actively watching your positions daily. And because you are making more frequent trades, taxes become a more complicated conversation. Short-term capital gains are taxed at a higher rate than long-term ones. What it requires: technical knowledge, time to monitor positions, emotional discipline, and a clear risk management strategy so one bad trade does not wipe out weeks of gains. Day trading is the one you see all over social media. You buy a stock in the morning and sell it before the market closes, sometimes within minutes. You are trying to profit from small price movements throughout the day. No positions are held overnight. It looks exciting, but here's the reality underneath the highlight reel. Day trading is essentially a full-time job. Professional day traders are watching multiple screens, executing dozens of trades, reacting to market news in real time. They have sophisticated tools, fast connections, and years of experience. And even then, many of them have losing days. The rules around it are also worth knowing. In the United States, if you execute 4 or more day trades within 5 business days using a margin account, you are classified as a pattern day trader. That requires you to maintain at least $25,000 in your account at all times. That is not a rumor. That is a Financial Industry Regulatory Authority regulation. Day trading also generates significant tax complexity. Every trade is a taxable event. Short-term gains are taxed as ordinary income, which, depending on your tax bracket, could mean giving back a significant portion of any profits. What it requires: a large amount of starting capital, advanced technical skills, real-time tools, extreme emotional discipline, and essentially your full attention during market hours. I want to spend a moment on this because I think it is important. There is actual research on day trading outcomes. Multiple studies, including one that tracked day traders in Brazil over several years, found that the vast majority of retail day traders lose money. We are talking somewhere between 70 and 80% of people who try day trading consistently end up with a net loss. Of the small percentage who do profit, very few make returns that justify the time and risk involved. That is not to say it is impossible to make money day trading. Some people do. But the people you see on social media showing you their gains are showing you their best days, not their average days, not their losing weeks, not the taxes they paid or the money they lost learning. Knowing this is not meant to discourage you. It is meant to protect your money. So what should you actually do if you are new? Start with long-term investing. Full stop. Open your brokerage account. Start with broad market index funds or ETFs. Contribute consistently. Let compound growth work over time. That is not a boring strategy. That is a wealth-building strategy. And it is the one with the most evidence behind it for regular people who are not doing this as a full-time job. As you learn more, you can layer in other approaches. If dividend investing sounds interesting, research it. If there are individual growth companies you believe in, put a small portion of your portfolio there. If you eventually want to learn technical analysis and try swing trading, do that with money you can genuinely afford to lose while you develop the skill set. But build the foundation first. Every advanced investor who is actually building long-term wealth has a core that is stable. They are not betting everything on trades. They are letting their money compound while they sleep. Your job as a new investor is not to be exciting. It is to be consistent. Long-term investing, buy and hold, let time do the work. Dividend investing, build income through stocks that pay you regularly. Growth investing, bet on companies with high expansion potential. Swing trading, short-term moves over days or weeks. Day trading, in and out within the same day, high skill, high risk, high barrier to entry. For beginners, start long-term, build the foundation, grow from there. Drop a comment and tell me which investing style caught your attention today and why. Like and subscribe so you do not miss the next one. See you there.